Good morning, everyone. We are the Northumbria University Newcastle Business School, Finance and Investment Management final year students. And I am Biam, and then my teammates Murat, Alexei, AB, and Eddie. We are going to make a presentation which topic is the active investment strategy. There's totally 4 parts for our presentation today, which the first part is smart money and the contrarian view, and then it is basic charts, will be presented by Murat. And the most interesting part, which is the technical tools, and the final part, which is the door theory and edit with.
So, good morning everyone, are you alright? My name is Murat, and today I'm gonna tell you a bit about contrary opinion view. In technical analysis, there are two main ways of investing: contrary opinion investors and following the smart money. Contrary opinion, contrary, opposite. Opposite to whom? Contrary opinion investors base their ideas, their rules on ideas that for people it's more easier to follow the ideas that are followed by the majority. Even by everyone, but it's impossible, so by the majority of people. And like for investors, for many people it's more easier to follow the ideas that are followed by the majority, even if that ideas don't have a strong confidence, even when they are wrong and incorrect. So that's why for contrary opinion investors it's more pleasant to trade oppositely to the majority of people. There are several indexes which are used by contrary opinion investors, and I'll tell you about 3 of them. First one is put-call ratio. Put-call ratio is the number of put options traded divided by the number of call options traded in a given period. The average value of put-call ratio never is 1.0 because investors prefer to buy more call options than put options. So hence the average number of this ratio usually is 0.7. But why we can use it? When the number of this ratio is close to 1 or even greater, so high, for the majority of people this is a bearish sentiment. And when it's near 0.5 or even less, it's a bullish sentiment. But we are talking about contrary opinions. For contrary opinion investors, this ratio helps to determine if the majority of people are too bullish or too bearish. So when the put-call ratio is much more greater than 1, contrary opinion investors think, the market is over bearish, so I'll be bullish. And the same for the second. When it's less than 0.5, contrary opinion investors think that the market is over bullish, so it is a bearish sign for them. Next one is investment advisory opinions. Who are investment advisors? That are persons or maybe groups of people that after making investment analysis, make investment forecasts or give you an investment recommendations for a fee, for money. They can do it whether through direct management of clients' assets, or for example via public publication in journals, books, some articles. So how do contrary opinion investments use it? When more than 60% of investment advices are bearish, then contrary opinions become bullish. If less than 20% of investment advisors are bullish, are bearish, so generally everyone, not everyone, but the majority are bullish, then contrary Contrarians are bearish because they trade oppositely. And the last one ratio I want to tell you is always a counter OTC versus New York Stock Exchange volume. The ratio of trading volume is considered a measure of speculative activity in the market. Always the counter issues are more speculative relative to the New York Stock Exchange issues, and speculative trading increases on market peaks. So, when the ratio of the OTC increasing to the nice volume, it means that fund managers are bullish, and looking at that, contrarians become bearish because they think that the market is overbought. And in contrast, when the OTC decreasing relative to the nice volume, we have the opposite situation. Fund managers are bearish, and then contrarians are bullish. So that's all I wanted to tell you today about technical and about contrary opinions. Thanks.
Hello guys, my name is Alexei, and I'm going to cover the part which is called smart money. It will not only help you to study well, but also help you to understand how to make money better. So the first point we need to understand is the basic thing that market has some cycle. And here you can see that market has a cycle. It goes up, goes down, goes up, goes down, and this thing has happened every once. So very quickly we covered this point. Here we can see how to create some support line and resistance line, but they will be covered by my colleague a little bit later. So the first point we need to understand is what is the smart money? How can we define this point? So the smart money is when you suppose that institutional investors are doing much better than others, and you try to do your trading the way they do. So when you're trying to do this, you suppose that they are rational guys, so they do rational decisions. The next point, that they are knowledgeable guys, that they have some additional knowledge you have no access to. You also think that they are professional guys and they have some special educations, MBA and other points. Another point, that they've got some strategy because they could work in some organizations like Goldman Sachs or other banks or something like this, and this company follow the majority of traders, and we need to follow the institutional traders. This point should be answered by the behavioral finance. Adam Smith told us that every person, when he tried to make an economic decision, homo economicus is a rational one, but it really doesn't true. Behavioral finance tells us that the majority of people are irrational, and then here's an example. You are going to market and you want to buy bread and milk, and you only need to buy bread and milk. But if you see, for example, gum, and you now want this gum, you will buy this, even if you, for example, want to collect some money for your weekend. Another example is a market example. When the majority of people, when they invest their money and they have some loss, for example 20% loss, it will be rational to sell your assets, but the majority of people try to just to hold them because they think, oh, if I'm holding something, some assets a little bit more, then the price goes up probably, and I will return all my money. But that's not true. That's why we need to follow the smart money. Means not to follow all investors, but only institutional investors. The next point is how smart money connected with indexes. And the first one I would like to cover, not the confidence index, but the smart money index. This index shows us the sentiment of the majority of traders, and it probably means that if the smart money index is high, you need to bet against the market in the morning, and to bet with market in the evening, because it's more clearly and more, it's better, because in the evening market is not so flexible. And what is the confidence index? So during the period of high confidence, investors are willing to invest in lower quality bonds. And for the added yields, which causes a decrease in the leverage yield for the late growth section of bonds relative of yield on high-grade bonds. So the next point I would like to cover is debit balance in brokerage accounts. And you need to pay attention, you really need to pay attention in increased in debit balance, because when money are borrowed by a company, it means they borrowed for something. Probably it borrowed for investing in other assets, in some assets, for doing some investment. And that means that institutional investors have some additional knowledge which can help you to invest your assets more profitable for you. The next point is very quickly the views of charts, and the first one is mountain chart. It's the basic themes. The second one is American chart. The third one is Japanese candlestick chart. And how to understand the Japanese candlestick chart? You can see if market goes up, the candlestick should be white or empty. If market goes down, it should be red or colored by some colors. If here's the highest point, it means that at this point, highest level. Here's the close point, the lowest point, and the open point when market's open, the close point when market closed. Here's the rarer chart. How can we understand this chart is to look at the number of x's and zeros. If the number of x's is lower than the number of previous x's, here's the 4 x's, here's the 5 x's, and the number of zeros is more than the number of previous zeros, higher than number of previous zeros. It means that market goes down. The next point is you can download information for you to do some trading skills from this site, stockcharts.com. You can download it and do some. You can trade your own data, the way you want, the way you can. You can construct some lines. You can do some additional trading chart, moving averages construction, and something like this. The next point will be covered by my colleague.
Hello, I'm Abby. Now let's have a look at trend lines. A trend line is a straight line that connects two or more price points and then extends into the future to act as a line of support or resistance. There are three basic trends: uptrend, downtrend, and sideways trend, also known as a horizontal trend. Support and resistance are two important things when we see a trend. Support is the price level at which the demand is thought to be strong enough to prevent the price from declining further. Resistance is the price level at which the selling is thought to be strong enough to prevent the price from rising further. In this trend, we can see this is a support and this also support. We can find that old support can turn into new resistance. This is resistance. Here is a breakout. A break above implies that the price may rise in the future. Now we come to moving average. Moving average is smooth data price to form a trend following indicator. A rising moving average usually shows that prices are generally increasing. But there is a lag because moving averages are based on past prices. There are two most popular types of moving averages: simple moving average SMA and exponential moving average EMA. A moving average is usually based on closing prices. It is an average that move along the time scale because all data is dropped as new data comes available. This green line is a 100-day moving average. It also acts as a support in this uptrend. A moving average can also act as a resistance in a downtrend. Simple moving average is easy to calculate. Here is an example. First day of 5 days simple moving average equals to 5 day sum of prices divided by 5, which is 13. Second day of 5 day simple moving average equals to second 5 day sum of prices divided by 5, which is 14, and so on. Exponential moving average is similar to simple moving average, but it places more weight on more recent data and thereby reduce the lag. There are 3 steps to calculate an exponential moving average. First, calculate the simple moving average as a start of exponential moving average. Then calculate the weighting multiplier. It equals to 2 divided by time period plus 1. Finally, we can calculate the exponential moving average. Use this formula. Today's EMA equals to multiplier times the difference between today's closing price and EMA of previous day, and then plus previous day's EMA. Let's move on to see how moving averages generate signals. If price cuts moving average from top, it indicates the price will decrease in the future, so it's a sell signal. For example, this chart belongs to Apple. Both simple moving average and exponential moving average are provided. We can see sell signals here, here, and here. After these signals, prices were really dropped. If price cuts moving average from bottom, like here, also here, here, and here, the price is predicted to rise in the future, so it's a signal to buy. To keep track of a moving average crossover system, moving average convergence divergence, which is called MACD or MACD, was developed by Gerald Appel. He defined MACD as the difference between a 12-day and a 26-day moving average. A 9-day moving average of this difference was used to generate signals. A buy signal is generated when the signal line goes from negative to positive. If it goes from positive to negative, it is a sell signal. MACD is best used in trendless markets and is subject to whipsaws. You can find more details from stock charts if you want.
Hi, my name is Ellie. Next, I'm going to introduce you some chart patterns. Firstly, head and shoulders. Head and shoulders top forms after an uptrend while the bottom forms after a downtrend, and it's a trend reversal. The pattern contains 3 continuous peaks, with the middle peak, which is head, being the highest, and the 2 outside peaks, which are shoulders, being lower and roughly equal. The reaction of each peak can be connected to form a support or a neckline. In real life, it's not an absolute requirement that the shoulder side should be exactly equal, like the screenshot. Thirdly, double tops and bottoms. Double top is a bearish reversal pattern which is made up of two successive peaks that are roughly equal, and with the moderate trough in between. And it's also called MY. The double bottom is called W. The red line is the support line and the blue line is the resistance line. And many potential double top can form along the way up, but until the key spot is broken, there are many kinds of triangles: ascending triangles, descending triangles, and symmetrical triangles. Then we'll move on to technical indicators. There are many types of technical indicators, such as MACD, ISI, OBV, and so on. Here we will concentrate on ISI as an example. J. Will Slider developed ISI in the book which was published in 1978. In the book, ISI is defined as a momental oscillator that measures the speed and the change of price movements. So, how to calculate ISI? ISI is broken down into three basic components: IS, average gain, and average loss. In the book, it is suggested that ISI calculation is based on 14 periods by Wilder. And one thing you should notice that the loss is expressed as positive value instead of the negative one. Here is the close price of the stock. We can calculate the change of price, use the new price minus old one. And then we put the positive value to the gain and the negative value to loss. Remember, the loss value should be expressed as positive. After that, we can calculate the very first average gain and average loss with the averages of the 14 periods, and then the next days, which is based on the prior averages and the current gain and loss. So are the following calculations. Here is the formula, this one and this one. After that, we can use average gain divides average loss. So we will get the value of RS. And finally, with the formula here, we can calculate ISI. Let's insert the charts of IS and ISI. You will find that the IS chart looks exactly the same as ISI chart. Let's go back to the PowerPoint. ISI oscillators between 0 and 100. According to Wilder, ISI is considered overbought when it's above 17 and oversold when it's below 13. This is the screenshot of Apple stock. When ISI is above 17, it seems most people have bought the stock, so the price couldn't go up anymore, which means a bearish movement in the stock price. And when ISI is below 13, the price couldn't be lower because most of people have sold the stock. So there will be a bullish movement in stock price. As we can see, the price movement doesn't exactly follow the indicators. So technical indicator is much more about trends, not science.
Okay, hello everyone. Before I start to present, I'd like to ask you a question. Do you know who is this man exactly? Anyone give me the answer? No one knows that? Okay, it's Charles Dow. Remember this name, okay? It's just here. Dow theory has been widely used in equity investment. However, Charles Dow, the originator of the theory, he claims that Dow theory is not used for forecast the stock market, even it is not designed for the investors. However, it is a reflective barometer of the market overall trend. The inheritor of Dow theory, Ria, in all his relevant writings are emphasized. Dow theory is a kind of tool knowledge which is designed for the investors to promote their investment ability, cannot be used out of the basic economic conditions and market situation, which is a comprehensive theory of strict technology. In other words, it is according to the study of the pattern of price. It is a kind of way for you to predict the future price behavior. Okay. Also, in Dawes theory, Charles Dawes believes that the stock price has already included the information from the market, which we can understand as the market price behavior has reflected all information from the market. Okay, I have made a very basic introduction about Dawes theory, and I'd like to talk something about his co-thinking now, which is the three chains, which the name of it is tide, waves, and ripple. You can see I have put a picture beside it. I believe all of us has been to the coast of England, right? Is there anyone haven't been to Tynemouth? No, that's great. It's a nice place, I like it. And if you has been there, I believe you also you will know the wave comes from the ocean because of tide, and you can surfing on the sea. That's a lot of people like to do that, and so does the stock market. Actually, the name of tide, we also call it a primary trend, which is a long-term direction, normally several years. And the waves, we also call it the secondary or the intermediate trend, which is a short-term departure from the primary trend, normally weeks to months. And the last one, which is the ripple, is not significant in Dawes theory. With the theoretical information I have said in the last slide, I think it is not difficult for us to see the three trends in this market now, which long-term direction for increasing, it is the primary trend. But in these several years increasing, it's not always in the same period, which in the middle of it, we can find that there's a couple of months, probably a couple of months decrease happened, which we call it intermediate trend. And all these small waves, which is the minor trend. Okay, edit with principle. If we say that Dawes theory has told us what is the ocean, hence edit with principle will teach us how to surf in the sea. In 1939, Ralph Nelson Elliott has formulated this idea firstly in financial world and make it become widely used over the world. I'm funny myself. Sorry. Okay. Edit wave is a market price trend and the reverse in the recognizable patterns, which is based on a repeating 8-wave circle, which we can see 1, 2, 3, 4, 5, and A, B, C. So it's 5 plus 3, 8 is it. And here is the very simple example about it, and which we can see is with a 5-wave structure called the motive wave, and the 3 structure called the corrective waves. In motive wave, which we can see the point 1, 3, 5 is effective direction of the market. However, point 2 and 4, which is the counter moves of the market. And also actually, there's a rule of it. The wave 2 can never move below wave 1. It can be moved as lower as the level, but cannot be lower than it. And it is very interesting. Actually, I have checked some charts on Bloomberg, and it really does works. So you can try it after class if you want. Now it's Fibonacci numbers. Fibonacci numbers, this amazing number is related with nature code. I believe you have seen some flowers in the real world. Like some flowers have 5 petals, like gardenia, sorry for my horrible accent, and the 8 petals, which is penny. And these all kinds of flowers related with Fibonacci numbers, which is 1, 1, 2, 3, 5, 8, 2, lots of it. And the cool thinking about it is any single number in Fibonacci numbers equal to the summation of previous 2 numbers. So we can see it's 1 plus 1 equal 2, 2 plus 3 equal 5, 3 plus 5 equal 8, and 5 plus 8 equals 13. Very interesting thing. And actually, there's also another thing I need to say is the Fibonacci numbers also related with the golden rate, which is 1.618. Finally, I'd like to say there are so many technical analysis tools, and there will be so many new things come out. But there's only one thing will be never change, which is you pays your money and you takes your chance. Before we finish today's class, I'd like to ask you some very simple questions as a quiz. The first one is, buying something at the peak of the property is against which one? A, smart money, B, contrarian view, C, Fibonacci numbers, and D, all of it. Who knows it? And you can get some coins, chocolate coins. If you like chocolate, this is the chance. Anyone give me the answer?
A.
Sorry?
A.
B. Exactly. You get this coin. I hope you will like chocolate. The second one, which one is Japanese candlestick chart?
D.
D. I will give it to you, chocolate coins. And this one, funny things. Which is a downward trend?
B.
Exactly. Please give me the reason why. No, you already get your coins. Because when we read the chart from Bloomberg for the stock market, we read it. Sorry, I have a problem with this.
C.
Sorry, still in this question. Because when we read the chart in the Bloomberg, we started from the left to the right, right? So, you see, easy. And this one, I think you already gave the answer. It's really quick. And it's, I'm sorry, what's the answer?
C. Electric.
You get lots of coins with chocolates. You will like it. I like chocolate. And the last one, what's the period about it? I think Ellie has already said in the presentation.
1730.
Sorry, lovely.
1730.
Exactly. Great. Do you like coins? Chocolate coins.
Love chocolate.
That's great. I like it as well. And okay, very last, I'd like to say thank you for attending our presentation today.